Hello everybody. So this video is entitled Zillow Stock. When is real estate making a comeback? I'm mostly going to talk about Zillow, a little bit about Reacts, and a little bit about interest rates, because these stocks have been trading entirely inversely to interest rates. It's as though the market was not looking at the fundamentals whatsoever. The market is looking at Zillow and it's selling off Zillow. Zillow is essentially at a 5-year low. I can show you the chart, getting ahead of myself in the video here. We're essentially at a 5-year low. We are back to the 2022 lows, to the levels of 2022, for a stock who has been firing on all cylinders, for a stock who has tremendous revenue growth. I'll get to that back in a minute. I think before we start even focusing on real estate stocks, whether it's Zillow, whether it's Reacts, whether it's even Opendoor. I don't have Opendoor in there, but Opendoor used to be a early darling of the channel. Whether we even start thinking about these stocks, we need to talk about the interest rate environment. Unfortunately, since the Middle East conflict, real estate seems like it's headed for a full-fledged crisis. If you look at the 30-year mortgage, we are almost 7%, and that is after we had spent a year and a half kind of recovering and starting up a recovery in real estate. We had dropped, the average 30-year mortgage had dropped below 6%. Actually, super well-qualified buyers, I remember back 6 months ago, they were able to get 5.5%, right, for a 30-year mortgage, which is actually palatable. Well, these days have been gone for the past 5 months, and now it's 7%. And now you have many people who are getting mortgages again at 7%. So that's the bottom of the real estate crisis that we saw sometime in 2024, early 2025. We're back at these levels. And why are we back at these levels? Because of macro. Because of Middle East conflict leads to oil up. Oil up leads to inflation up, which means that rate expectations are up, which means that real estate gets sacrificed. It's actually crazy to think that the mortgage now is about 7% for a 30-year, and it's not quite there, but if I'm exaggerating for a headline here, I could tell you it's nearly 2%. And sure enough, for some buyers, it's 2% higher than it was 6 months ago. Sure enough, right? Because these rates, of course, are more sensitive the lower the credit score of the buyer. So anyways, if you look at the main stock I'm going to talk about today, which is Zillow, we're back essentially at a 5-year low. Yeah, sure. We're like $5 up from the 5-year low. So 15% higher than where we were. But if you look at Reacts is the same story. Enormous low. And for Reacts, they did an acquisition. They acquired Keller Williams. You may say, oh, Reacts is way down because of the acquisition. Well, when I look at the charts of the sector, I tell myself it's not down because of the acquisition. It's down because of the interest rates. Unfortunately, these stocks are very much interest rate sensitive. And that's very unfortunate, because whether it's Reacts, whether it's Zillow, I don't follow Opendoor anymore, but I'm sure Opendoor has some good growth numbers as well. These companies are actually firing on all cylinders. They're actually growing. The market is ignoring them. Hence today's full video. Today's a sponsored video from one of my long-time Patreon supporters, and it's on Zillow. So we're going to talk about Zillow. So first of all, before I begin talking about Zillow, I just want to say this, just like when I cover Bitcoin companies. If Bitcoin fails, if Bitcoin doesn't do well, Bitcoin companies are not going to do well. The same is true for real estate. If real estate continues to be in a bear market, if this you may say, oh, the prices are holding up pretty good. Well, that's because people are locked in old mortgages, so that's why they don't want to really sell it too cheap. But at some point, if we don't get a move in real estate, if we don't get transactions up, if we don't get transactions up in real estate, at some point we're going to have a price drop, because we are nearing the number. If you look at, I think the average move in America, every American moves on average every 7 years. So this crisis has been going on for 6 years. So I can guarantee you there's a lot of people who are waiting to move right now. who are trying to move, who can't move because they can't unload their real estate because of this crazy situation where they're locked in a 3% or in a sub 3% mortgage. And if they were to get out of real estate, that means they can't get into a new house because the mortgages are 7%. So it's been ridiculous for far too long. But if it continues to be this ridiculous in real estate, if real estate continues to hurt, unfortunately, a business like Zillow, in my view, will continue to hurt because these businesses, whether it's Zillow or Reacts, they're impacted mostly by listing velocity and how many times homes change hands, right? They make commissions. You may remember this was an entire chapter in a book that I used to really like in the 2000s, which was called Freakonomics. If you listen to this book, there's a whole chapter about how real estate works, and it's really not about selling high for real estate agents. It's about frequency. It's about selling a lot. Even fire sales create much more revenue. So the incentive is actually to have volume. The incentive is to sell. The incentive is to oscillate. People changing homes all the time. That's the incentive. And that's what's not happening right now. Transaction counts are down. Right, closings are down, and that's why it's hurting a business like this. And unfortunately, it's going to be way more down if we stay stuck at 7%. And as far as Zillow, this is a fundamental video, but if one were to interested in buying in Zillow, they report their earnings in 2 days. Right, I would be careful. Like, I don't know what they're going to say on that call in 2 days. What are they going to say? Are they going to report a catastrophic summer season for real estate sales? Because it sure seems like summer probably has not been too good with the rates being this high. How many people backed out because by the time they lock in a mortgage, it's too high and they find out they can't afford it anymore? So I would be even wary looking at this stock in the short term. I think this is more of a longer term conversation because I think there's a lot of elevated uncertainty before these earnings. Anyways, let's talk about Zillow now. Let's talk about the business model. It is an amazing business model when transactions are doing well. This is a company that makes a lot of money. It's an asset-light business, and they have a pay-at-close model. So they earn a portion of the commission earned by the realtor. They earn a portion of the business that they bring to the realtor, right? So if you use Zillow, it looks like it's free to you as a user, as a buyer of home. But if you contact the realtor through Zillow, forget about it. Zillow is going to make a percentage, and they're going to make, on average, from what I understand, it's about 30%. But this is individual, this is by market, this is negotiated, but they make at the very least 15%. 15% of the commission, at the very, very, very least. So they make money off of the commission of the real estate agent. And that's 66% of the revenue still. 66% of the revenue. Now, of course, like any business in that sector, they are trying to get into mortgages. That's a tough one right now, but that's 8%. And then the rest of the money they make is the rentals, 24%. And they have a small advertising business. When this business matures, my guess is that advertising will be a bigger portion. This is the same as Amazon. Amazon now makes money from advertising products. People advertising homes on the Zillow platform, eventually they will make money from that. But for now, that's a small share of the business. For now, the business is mostly residential. That's the share on the fees earned by the realtor. And rentals. This is the biggest business. Mortgage is a nascent business. But if you look at the recent growth, much of the recent growth in Zillow has been from growing the rentals business. The rentals business is actually now 24%. I like that very much, and it's logical. If people don't buy homes, if people can't get into new homes because they gave up a 2.75% mortgage and they now have to pay 7.2%, what are they going to do? They're going to rent because, people can't really be homeless. So you really have two solutions. You either rent or you buy. And so it makes sense, of course, that as transactions on real estate are down, that rentals would be up. And the rentals business has been growing more than twice as fast. The revenue from the rental business at Zillow has been twice as fast, growing twice as fast, not twice as high, but growing twice as fast as the buy and sell business. The buy and sell business has declined because real estate is in a crisis. So you can see we have multiple layers of risk here. There's the business execution risk, but there's the interest rate risk. It's all about the interest rate. It's all about the interest rate. Now, In this very, very tough backdrop of high interest rates, which means that people don't move out of homes, people don't buy new homes, people stay put. In this tough backdrop, you have a company who has grown at a 21% CAGR, grown revenue on average a little more than 20%. Now, you've noticed since 2021, we've kind of had a valley of despair. The growth has resumed. But if this year is another gray swan, it's possible that the revenue is not going to be growing as fast this year as they even guided. They guided mid-teen revenue growth for this year. We'll have to see in the next quarter if they actually achieve mid-teen or not. But you see, much of this business is predicated, much of the investment thesis in this business is based on what if real estate returns to normal, what they called a normalized housing market. What if we were to return to a normalized housing market? Not even the boom of 2020, 2021, just a normalized market. Well, if we were to get to a normalized market, you can see they could expect volume on transactions to go up by close to 30%, right? Close to 30%, because the average turnover has been 4.1%. We are now at 3%. We are at a and that's probably lower now since the rates are up. So we are at a historical low as far as turnover of homes go. There's 1/3 less transactions every month than there used to be when the real estate market was normal. And so, of course, that's an enormous unlock for revenue growth for Zillow if the market were to just go back to normal. But Zillow shows us in the investor presentation, they've still been able to outperform the market. The revenue growth at Zillow has been 16%. It has been very good when the number of homes sold is down 19%. They've been gaining market share. They've been growing, right? Traditional mom and pop realtors are becoming less and less relevant when they compete against the real estate super app. And if you're not in the US, let me tell you this: Zillow is the super app of real estate in the US. It is. It's not Trulia. It's not. They have a few other ones. They have a few local ones sometimes, right? But it's not Trulia. Trulia is not the leader. It's not, what is it? The MLS. Yeah, the MLS is something your realtor sends you. But oftentimes you contact a realtor via a Zillow listing. Oftentimes you'll end up on a Zillow listing. You'll see a Zillow listing first, and then you find a realtor based on Zillow. So Zillow, in my view, competes against the MLS. They've made the MLS very much obsolete in my view. MLS looks like it hasn't been outdated in a decade or something like that. Anyways, if you've used the MLS, if you've been in real estate, then again, like most people, I haven't bought a house in a very long time because the market has been just awful. So anyways, if you look at their predictions here again, if we normalize, they could expect an increase in sale revenue. So remember, that's only 60% of the business or something like that. They could expect an increase of 1.3 billion if this normalizes. If real estate normalizes, this is a business that's going to move from 15% revenue growth to maybe 80% revenue growth the year that real estate normalizes. And maybe it's going to take multiple quarters. Maybe it's going to take a year and a half. But we're going to see a major spike in revenue when real estate normalizes. The question is, when is that going to happen? It's probably based on the macro. It's probably based on the Middle East. So they do everything that they can to try to become that super app. The bear market is for building, and they have been building a lot. And they have new features. They have sales relationship management software that they bought. They have a Zillow preferred program, Zillow Showcase, right, introducing some AI to make a better viewing experience. They launch home loans. They have a closing division. This is the classic playbook of somebody trying to grow in real estate. They have a messaging app. They're trying their best to grow their features and grow the business and sharpen the saw to be ready for when the real estate picks back up. That's their Zillow home loan, by the way. Here they've been successful at integrating and at selling more and more loans and making more and more money. But it's this, in many ways, this type of business reminds me a lot of Bitcoin companies, right? It's like anything crypto or Bitcoin related is not doing well right now because the underlying asset is not doing well, right? Zillow is not doing too well as far as stock price goes, because the underlying asset, right? It's a derivative of real estate, and real estate's not doing too well. It's really, really that simple. This is a stealth bet on real estate. This is a tech-enabled bet on real estate. When real estate picks back up, my guess is Zillow is gonna do stellar. Now, one bright spot for them, for Zillow, but that's only 24% of the business. But one bright spot for them has been rentals. Rentals have been pretty much saving the business. So if you look at their rental business, so not only is growing fast, 2018 to 2025, they have 25% CAGR, but if you look at their more recent growth, they're actually exhibiting 37% CAGR for multifamily properties, and for the revenue itself, so the number of rentals in terms of count, that's 37%. And then there's been price increase. So they've actually been growing in recent years, right? In the past 3 years, they've been growing 48% CAGR for rentals, for real estate rentals. And it makes a lot of sense. If buy and sell homes is not doing well, then rentals are going to pick up the business, because people generally don't want to be homeless, so they don't have a choice. They either do rentals or they do homes, and so rentals have been doing much better. That's why we've been growing to the rental business at 24% of the total revenues now. Rentals, it used to be 14%. It also helps that there's no major competitor in rentals. There's no MLS, right? If I were to say who's the biggest competitor to Zillow, it's the MLS, right? The Association of Realtors, their website. That's the biggest competitor, I would argue. So Zillow is still competing against the MLS. There's no such thing for a rental market. So Zillow is kind of consolidating everything on their platform, right? And they're doing better than some other websites, like a heavily advertised website in the US for apartments, apartments.com. You see them all over the internet and all over the radio. If you look at Zillow's ranking in the investor presentation, apartments.com is something like number 5 or number 6. It's not as much of a habit as to just get on Zillow. Zillow has become synonymous with looking for real estate. It's become a habit to go on Zillow. How many people have the habit of looking at their house on Zillow, for example, and just tracking the price of their home on Zillow? It's a big deal. Zillow is a big deal in the US. They've won that network. They are the super app of real estate in the US. So anyways, you can see this is their value chain. They're building an entire value chain for rental business between mover and landlord. And they handled the touring, the application, the lease, collecting the rent, even insurance. They try to handle everything. Move to the real estate super app, building a real estate super app, right? In its own segment. And so there's a few companies that try to build these accommodations or real estate super apps. Zillow is doing it for buy and sell. I would argue Airbnb, when I used to cover Airbnb, that was also one of the things that Airbnb wanted to do, was to create like a super app for renting, right? So that was also a thing. And if you look, so their growth on multifamily is doing well, outperforming industry growth. And like I said, 48% CAGR. So rentals have been saving the business right now. And my guess is rentals will not do as well as soon as real estate makes a comeback, as soon as buy and sell makes a comeback, because presumably a lot of these renters don't want to rent. A lot of these renters presumably want to buy. And they want to buy. If rates go back to 3 or 4%, that's when they'll stop renting and they'll want to buy. So I expect these two sides of the business to kind of swing one way or the other as the market evolves. So anyways, now that I've told you about the business, the top of the funnel, what they do, let's just look briefly at the cost. Let's look briefly at the business. They've been managing the bear market, in my view, very, very well. You can see they advertise less. They've dropped their advertising spend. Now only 7% of revenue goes towards advertising. Their fixed costs, they've dropped them enormously. They've implemented a lot of AI. They've invested a little bit in sales officers and salespeople. And salespeople, of course, always pay for themselves, so that's fine. But even that increase has not been nearly as sharp as the decrease in the costs. So a business managing the costs, decreasing the costs in order to handle the bear. They've even decreased stock-based comp, which is something that I think a lot of my viewers will like, because in general, we don't like, my viewers in general don't like stock-based comp too much. I happen to not mind it as much, because I realized that if you don't give stock-based comp, you're going to give more cash, and you're going to make the business more fragile because more cash is going to get out of the business. But it's nice to see the managers not paying themselves too much as the business is not doing too well. And of course, a bright spot is the buybacks. They have a pretty large buyback in place, and they've bought back a bunch of shares, actually bought back twice as many shares in 2025 and 2024. We'll see how many more shares they end up buying back. But the buyback is a nice program. And lastly, I'll leave you with this. I'll leave you with the stock price. A very depressing stock price. Really, the stock is still down 65% in 5 years. But really, if you started looking at this stock 4 years ago, it's about the same price as it was 4 years ago. Yeah, we almost reclaimed 100 when we thought real estate was making a comeback. When rates were coming down, that was last year. We almost reclaimed 100. And then, of course, this year, it's been nothing but hell when it comes to rates this year. And so we've dropped by more than 60% again, 65, 66% again. So, if rates go back to 4%, is this stock going to 3x, 5x? In my view, it's highly likely. No financial advice, but it's highly likely. If we get to a normalized real estate market again, these are stocks that could do very well. The big question is, when is real estate gonna make a comeback? I would, if you had told me back in 2023 when I was starting out this channel, if you had told me that real estate wouldn't be back in 2026, I would have been shocked. I would have been flabbergasted. I wouldn't have believed you. And the fact that we're 3 years since that time and we're still in a crisis for real estate, it's becoming a big problem. It's becoming a somewhat of tragedy, and assets in this decade have not been too well. And stocks, the indices have been doing okay, but if you've been a stock picker or outside of AI, you haven't been doing too well. Real estate has not been doing too well. Think about how many people love real estate. I talk about stocks on this channel, but for every person that loves stocks, how many people do you have that love real estate and who put everything in real estate? Maybe two. Maybe you have two real estate people for one real estate folk, right? If you hang out on X, if you go on X, how many threads do you see about real estate and rental real estate and all sorts of fix and flip, Airbnb? Real estate is a huge sector that has been underperforming for so long. I happen to have never really liked real estate, but I know a lot of people like it, and a lot of people made money in it. But unfortunately, at 7% interest rates, the math doesn't work anymore. And especially with inflation and roof replacement, HVAC replacement, insurance, it's a tough business. So as far as valuation, let's go with valuation. The stock is cheap at a 0.23, but it's not too cheap. It's cheap, but it's not too cheap. Keep in mind, this is a very asset-light business. So this is an asset-light business. This is why 0.26. And again, I can only compare it to Reax. Reax is not, it's a little bit asset-light, but Reax actually is a broker, right? They are a brokerage, so they do a lot of the heavy lifting. If you look at Reax, enterprise value over gross profit over revenue growth is a 0.03. So trading at a zombie grade type of valuation for Reax, Zillow is really not there. But Zillow is a fully digital. It's a network. It's a network that I don't foresee being disrupted. I don't see how it could be disrupted. Everybody knows Zillow right now. Everybody's house is on Zillow right now. So I don't really see how you disrupt Zillow. So there is a lot of intrinsic value to the Zillow website that is put in the valuation, but nonetheless, 0.26 is pretty cheap. And the stock is essentially at a 5-year low. And so, in normal times, I would tell you this is very compelling and this is exceptional. Reax is, of course, also at a 5-year low. But the question is, how many stocks are at a 5-year low right now? Right? So many. So many stocks have been left out by the market and forgotten by the market. This is yet again one of these stocks. So what I would do with Zillow, before I get back into these stocks in any heavy type of sense, I would need to see the 30-year go down. I would need to see some concrete indication that the Middle East situation is going to get resolved and that oil is going to move back to 60. And I would like to see the people at the Fed stop dissenting and asking for more rate hikes, because you could create a US-wide crisis in real estate, something similar to what they have in Canada, if we don't do something about the rates. So something needs to be done, and unfortunately that doesn't depend on Zillow, that doesn't depend on the stock picker, that depends on the macro. Yet another company who's heavily impacted by the macro. And so stock is cheap. Then again, there are a lot of cheap stocks right now, a whole lot of cheap stocks who may not be as dependent on macro as real estate is. So this was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.